Thank you so much, David, Diego, Sarah and the team at realestate.co for having me involved today. What an amazing first conference to be part of. I'd have to say first up, it's a little bit of a hard act to follow. Teresa, obviously an incredible person with some incredible experiences, but mostly because I thought I might have the fanciest top today, and she's immediately outdone me. So you've made it hard to follow up with a brilliant get-up like that, Teresa, well done. As David says, I'm going to take you through our take on the market. It is somewhat of a bit of a roller coaster, I guess. You know, we have to do a little bit of looking back to see where we've come from to understand where we're going to go to next. But ultimately, as the first slide here says, it's all about the fact that now interest rates are falling. The interest rate relief is here. That has been the big change in that last month, which in every conversation I have, in every piece of data I look at, that's what is coming up. That has really led to a change in mindset, and that's where vendors, buyers, everyone's come out of the woodwork and started to talk more about what are my options. So things are definitely on the improve. I will run you through our usual very data, stats heavy information on our read on the market. And at the same time, I wanted to change things up a little bit today, and I wanted to really talk about how we can get this data in your hands to make sure that you can have those conversations with your clients. Use CoreLogic, use our independence, use that profile that we have out in the market, out in the media, and say, this is what CoreLogic says. It's not coming from you, it's coming from an independent source, and that's one way of establishing that trust with those potential vendors, those buyers as well. But let's get into it. It's all about that interest rate relief. And I do think we have to look back a little bit to see what's been happening more recently. And there's no doubt that previous momentum, that shift we sort of saw about a year ago, where the market did come back a little bit, has fallen away. And when we look at that very briefly on how values have changed over time, that's the left-hand chart there, you can see that little bit of growth that we saw towards the end of last year, start of this year, but then things have slowed down. We've actually seen values decline 3.7% since they had that mini peak in February. Now, important to recognise it is likely changing, but we have been through that difficult period. Now it's all about what's next. Map on the right-hand side, look, there's not too much to read into that one. Red means values have declined the last 3 months, or orange. Blue means they've increased. There's very little dots, very few places on that map which show values have increased in the last 3 months. It is pretty much across the board we've seen that difficulty. Let's acknowledge that difficulty and then try and move forward with what's going to happen next. Now that chart and that information is according to our new home index. We're changing the way we're measuring values over time. So we've now got this new index which has been in market for 2 months, which is a lot more granular than what we used to publish. We want to get more data in the hands of yourselves to understand what's really going on through the property market. And this home value index builds up the value of every single property, every single week, by looking at all the key characteristics of that property, essentially apportioning a value to a bedroom, a bathroom, for every square metre. The location of that property will apportion a value to that too. And really interesting thinking about what Elsa was talking about earlier, what's the value of increasing my property by a bedroom? Or if I do an extension, this index can now start to understand that much better. And some of you might have seen an article which was published, I think, earlier this week, written by Ed McKnight from OPS Partners, using this data to understand where you can add value. This data is readily available. Go out there and find it. And so you'll see that on many of my slides today, I have included a link, always at the CoreLogic website, to go and check this data out for yourself. The other thing we've done with this index is that we're now tracking the value movements weekly. So you can actually go in there and see what's Auckland property prices done the last week. And I think I had the notes down was, Auckland values still fell by 0.2% in the second week of this month, but somewhere like Christchurch was up 0.1% in that second week of the month. And this data is much more reactive than our old index used to be. So we've made lots of improvements to this. We're now also splitting it out so you can understand what's happening really easily with houses compared to, say, flats or townhouses compared to apartments. And that's what some of this data talks about. I'm not going to go into it in great detail, but I think what's really interesting is that chart on the left-hand side shows you value change from pre-COVID to now. And what I want to focus on is the scale of that growth, or in some cases no growth, but some of the differences across the regions and some of the differences by property types, because it tells us about what's happened in each of these markets over time. And I don't know if you guys have spent that time more recently to understand what has the actual change in value been since pre-COVID. It's 4.5 years ago now. Gone by pretty quick, I think. I don't know about you guys. But interesting when you think 4.5 years ago we first went into lockdown and we've been through a massive upcycle, declining values, then this little bit of a weird up and down more recently in the last year or so. But actually looking back 4.5 years now, in Auckland, for example, for houses, they're only valued about 11% more now than they were pre-COVID. Not much, right? Average of 2.5% per year. Does tell you that actually that decline was pretty significant. But we've got some differences across the regions too. So Auckland, that's the black bar on the left-hand side there, that's the houses. Townhouses haven't grown by as much, and apartments are actually worth less today than they were pre-COVID. Pretty big changing market, that apartment market. Demand for it has changed a lot. Don't have the same level of tourism, hasn't quite got back to the levels it was. We had a massive period of no international students coming into the country. Really changing demand perspective for an apartment, and that has led to it not seeing that same growth in property prices over that period of time, but also means it might be set for more future growth as that demand comes back, as the money, of course, starts to free up. But then, of course, regionally, there's some big differences too. Christchurch, 40% up on 4 years ago. So the growth that Christchurch saw was much more sustained. Partly because it hadn't had the same growth phase that Auckland, Wellington, even Dunedin, all these other cities had pre-COVID. Christchurch hadn't seen it. We increased supply dramatically following the earthquake, what's that, 12 years ago now in Christchurch? And that supply really did keep prices down across the Christchurch area. So we didn't see much growth through that decade, and then COVID hit, saw growth like everywhere else, and it's just been more sustained because actually it's more affordable to buy in Christchurch than many other parts of the country, particularly look at big centres. So some big differences there. And then the chart on the right-hand side just shows you that volatility through that period of time too for Auckland. So the black line are houses, how they track through that period. You can see there, houses grew at a faster rate consistently through COVID, more so than, say, apartments. Again, we talked about those apartments not having that consistent level of demand. And of course, what do houses bring you? When you buy a property with a house on it, with land, that land is a key reason that people buy that property, especially in Auckland where there was potential for development. And so we saw a much greater upswing of those houses, but we've also seen that decline as maybe people bought with development potential, a property with a house on it, then couldn't get that developed, maybe couldn't get the builders, maybe couldn't get the consents done, money got difficult, and so we've seen that slide back again by houses. You'll see that black line actually drops below the others following that. But it does just show a bit of volatility there because of that expectation on what you can do with land, the potential development opportunity that it brings. So lots of detail there. Again, there's a link. Definitely the slide deck will be PDF'd and sent out or available to you all. So please do take advantage of that and go and check out some of the detail that is available for you guys to have those sharper and more deeper conversations with anyone that's in the market. Including all of that data, well, it's a bit more simplified actually, but by suburb. So our Mapping the Market tool is updated every single month. We put a press release out every month or even every 6 months on this, but every month this data is updated. What's the median value of property in every suburb across the country? Today, click a different button. What's the median value a year ago? Click a different button. What's the percentage change been the last month, last 3 months, and last 12 months? All available for free. And you can start to try and pull out trends here, right? So anytime you talk about Auckland, one number is kind of pointless, right? It's kind of like the New Zealand property market. Who cares if the New Zealand property market's gone up by 1%? No one buys a house in New Zealand, they buy a house within one of the cities within New Zealand. So we need to get a bit more granular when really becoming those local experts in what's going on. This data is freely available, and you start to pick out where some suburbs are doing better than the surrounding ones. And anyone that's in that area, you'll probably know why. And that'll help you have that conversation, provide the data, and you can talk about that in greater detail. I think here you can see in Auckland, this is a 12-month change, so it's a little bit longer. It is looking over a longer period of time to see where our value's at today compared to a year ago. Blue means values have grown, orange means values have declined. And you can see there that sort of the Auckland City fringe area done pretty well in the last year, couple of percent up, but maybe out west here, North Shore, not as much. So we can start to pull out these trends, give us that better conversation. Again, the link's there to go and check this data out for yourself. Now, perhaps one of our most valuable data sets at CoreLogic is our buyer classification data. It is this chart, particularly on the left-hand side, where we classify every single residential transaction to one of those buyer groups. The three main ones being a first home buyer, a multiple property owner, or a mover. Now, really interesting when you look at that chart, first home buyers are in red. You can sort of see they hovered down around that 20% mark for a long period of time. They have increased over the last decade or so. And they've actually done pretty well in the last few quarters. First home buyers will find a way into that market. They will adjust their expectations. They're using their KiwiSaver. They're taking advantage of a slightly quieter market from other buyers. And they will get that funding one way or another. We've seen that before, and we'll continue to see that in the future. Despite all changes that have occurred, increasing interest rates, whatever it is, first home buyers continue to find a way. They will continue to be a market for you guys. The two other key buyer groups, that light blue one that's dipped now down to about 21%, those are multiple property owners who are buying a property and using a mortgage to secure that purchase. Definitely less active more recently. Did pretty well through the peak COVID times, definitely filled their boots. Regulations were reduced, money was easy to get, money was cheap. Investors were out there buying property a lot. But they've declined a lot because a lot of that regulation which came through from the previous government made it more difficult, and increasing interest rates, of course, made it even more difficult. But when I start to think about what's happening with investors now, they're finding opportunities. Interest rates falling basically means straight away their finances improve immediately. Then you add the regulation, being able to claim their interest costs back in their tax return, that starts to add to their profitability. And so they're back out there already. They're already out there talking, trying to find those opportunities. They will continue to do so. You know, we know, and actually the chart on the right-hand side, let's jump to that briefly, that looks at those multiple property owners and says, how many properties do they actually own? What type of investors are out there at the moment really active? And it's the smaller guys. That red line on the right-hand chart are multiple property owners with 2 properties after their most recent purchase. So likely a first investment purchase. Someone that probably has lived in their own home for 10, 20, a lot of years, built up a lot of equity. And now they're looking forward and going, what do I do with this equity I have? Property is going to continue to be a favoured option for long-term investment, for retirement, passive income. You can see the actual investment you own and you can leverage to get into that investment. That ain't going to change in a hurry, and actually regulation, of course, with the new government is starting to improve once again. So investors are back out there. The second line on that right-hand side are multiple property owners with 3 to 4 properties. So potentially it's their second or third investment property. They are also coming back in. Meanwhile, the yellow line, quite hard to see on that chart, a little messed up down the bottom there, but it's dropped away to 2.5% of all sales going to a really big investor. They're finding it tough right now. They're upwards of sort of 4% previously. They're finding it tough. High interest rates, if they've got lots of debt, lots of property, finding it really difficult to add that extra property. And the DTIs, debt to income restrictions, will certainly continue to slow down those type of investors. So the smaller mum and dad investors are going to be the ones that are going to be more active out there as interest rates continue to fall. And the number I always reference now, if you've seen our monthly chart pack, again, freely available, you can download it, you can subscribe to have it sent to you every time. It's a free monthly pack that tells you everything that's going on in the market. In that pack, on the first page, we talk about the value of residential property in New Zealand, $1.2 trillion or something like that. And it also has in that same page how much lending is done on residential property, about $230 billion. That leaves an overall LVR, loan to value ratio, in New Zealand of about 21%. That means there's 80% of equity out there that can be used to invest somewhere. One was being property, of course. There's plenty of other good investments out there, but it is going to continue to be an option. Those investors will continue to be active, especially for those owners that have been in for a long time, seen their equity increase, looking at their next options. So I think we can talk about first home buyers continuing to remain strong. Investors will certainly be coming back into the market as finances improve. What about that mover group? That's the black line that sort of hovers along the top. Typically a pretty active group that's dropped away for the last 2 years or so. So I think it's dropped down to, hard to read that number, 24.8%. That little black line just dipped away. But actually it's been consistently about 26%, well down the long-term average of about 29%. Now, why do you move house? Why does someone move house? It's because of a life stage change, usually. It's been talked about today already. And those life stage changes haven't stopped happening in the last 2 years. So there's a good reason to say there's going to be some pent-up demand from these would-be movers who could have moved in the last couple of years, haven't been able to, or haven't had the confidence to. They could now start to move out and look at their options, upgrade their property, move to a better area, maybe downgrade their property if we've got ageing population. All of these people will be back out there looking at their options. And I was presenting at a bank last week and they said to me they've already seen an uptick in people asking for bridging finance. So they're already out there saying, actually, I'm getting more confidence in the market. I can see that now's the better time to make that step up or whatever it's going to be. And actually, I just want to see what my situation is, just in case I don't sell my old property for as much as I want maybe. How long can I bridge for until I sell that property and wait till I get the price I want as the market improves? So maybe you can buy sooner and sell a bit later, hold 2 properties for a section. You can actually really time that market well as property prices increase. So again, there's a third scenario where I can see movers coming back into the market. Now clearly, not all 3 buyer groups there can start to continue to increase. That chart is a proportion of all sales. It has to add to 100. What that does tell you though is if they all do come out of the woodwork and they start to look for property and start to buy property again, it means increased competition. It means upwards pressure on prices. At the very least, it means no more, well, a slowdown of the decline in prices, but certainly likely to lead through to growth in prices as well. And I think that's why this is a key turning point for the market. This is another one really just talking to the investors. I think this will be an interesting one the Reserve Bank will be watching. It's their data, the left-hand chart. A lot of detail. Let's just focus on the black line there. That black line shows you the proportion of lending done to investors with less than a 35% deposit. Because the rules changed on the 1st of July, meaning the deposit requirement for an investor dropped from 35 to 30%. And what do we immediately see? 20% of all lending to investors has taken up that allowance. Without interest rates really falling in July. That's July data. I think August data comes, or maybe even be out today. So we've immediately seen investors, despite interest rates, maybe they knew they weren't going to go any further up, and there was hints of them coming down, but we hadn't had the Reserve Bank decision by then, and yet we've still seen investors go in and actually take more lending on at that higher LVR level or lower deposit level. So there is a bit of activity already coming through from investors just because they can. That's going to likely add, that change in the LVR requirements from the 1st of July will add demand to the market. Now the key thing at the 1st of July was we also saw the debt to income restrictions brought in the same day, which technically should slow down the market, should restrict demand. But right now, there are so few people borrowing more than what they're allowed. For investors, in this example, more than 7 times their income, it's below 5%. The speed limit for the amount of lending banks can do to investors above 7 times their income is 20%. So there's room to move here. So the immediate question we had was, at what point will interest rates get to before the DTIs kick in? Until we sort of see any restriction from the DTIs, it's not going to be until interest rates fall, our borrowing capacity increases, we can borrow more, then that cap's going to kick in. Our calculation, it's pretty rough, to be fair, although I did actually throw this to the Reserve Bank and they had similar calculation as me, so that made me a bit more confident in our numbers, was that we reckon about another 1% of interest rate fall until we see the DTIs kick in, and that could be about a year away. Maybe even shorter than a year away. So it might just mean in the short term, in that year, we have sort of a net boost of demand because LVRs are loosened, DTIs won't kick in until that starts to restrict demand. So it's in this next year where we feel like that demand will be sort of at its most growth until there's another thing that kicks in and slows it down. So I think that's certainly one thing to watch for in this next 9 months. One more on lending. I won't touch on this for too long. You guys probably get the same question that I do, and I know that mortgage advisors get all the time. How long should I fix for? Now, I'm not going to give you an answer today because I'm not a financial advisor. What I can tell you is what people are doing, and most people are still favouring the year. In July, 20% of all lending or borrowing that was taken in that month was fixed for 6 months, another 40% for a year. So despite those 6-month rates, of course, and everyone going, well, rates are falling, so take the 6-month rate, refix in 6 months, people are still favouring that year. And it's a pretty good reason to it. When you do some calculations, once again, I love these calculations, pull up Excel, post some scenarios. I've tried to do some calculations that show which might be better. And again, not personalised advice, figure out these calculations. Some people like certainty, some people want to chase every last dollar. But right now, the 6-month rate, let's say, is 6.85%. 1-year rate, 6.29, pretty decent gap there. So you can choose that 6-month rate if you want, but it's quite a bit higher than the 1 year. You would need the 6-month rate to be around about 5.55%. That's a 1.3% drop in order to, in a year's time, be better off than just choosing the year. Not a perfect calculation. Do the sums with your advisor. You know, go and look at your situation. You might even want to, your payment will be consistent through that time if you take the year, whereas over the 6th month, you'll pay more now, but less later on, but it'll all balance out. So go and check that data out anyway. And the right-hand chart just very briefly just shows the 1-year difference in the 1-year rate, if that makes sense. So it just basically says today the 1-year rate is 6.29. A year ago, it was how much different? And then what do we expect it to be in the future? We are in this declining interest rate environment now. We just pin that to the OCR forecast, and we know that we're seeing declining interest rates for the foreseeable future. Probably hovering around that 0.5 to 1% lower every time the year comes up. All right, let's move on from all that. Took a little bit longer than I expected, so I might have to work through the next stuff a bit faster. But when we're looking at, I've sort of talked already about how those different buyer groups are going to shape the next period of the market. It really is about these rate cuts beginning. The fact that we finally saw the OCR drop last month. Somewhat of a surprise, but definitely the right call. And the really interesting thing at the time, I think, was the difference from May, the Reserve Bank's forecast, for the OCR to August, that 3-month period changed dramatically. In May, they considered lifting the OCR and had it within their forecast that it would be lifted at least one more time. In August, they cut it and basically forecast to cut at every single decision from that point on. Pretty dramatic change. They took some heat from it. But the one thing they talked about was they put more credence, I suppose, into high-frequency indicators which pointed to a material weakness in domestic economic activity in recent months. That was the quote taken from the statement. That was a big shift from what they usually say. Because the key thing out there for all of us tracking those big data sets is there's a bunch of tier 1 statistics with the official data, official GDP, official unemployment data, official labour market, official inflation data. But there's heaps of other cool data sets that are released more frequently, monthly, not always by an official government agency, sometimes it's a private organisation. And the Reserve Bank have been tracking those things, but not usually using it as their key Bible, I suppose, to help them make decisions. In August, they flipped that, and they now are. So now we can also pay a lot more attention to those more high-frequency indicators that are out there to understand what's happening in our economy, which is an economy that is absolutely struggling right now. And make no bones about it, this economy needs support, and that support comes in the form of cheaper money. And that's what the Reserve Bank's up to now. Look at that chart on the right-hand side. Our GDP forecast is still flat for a bit longer. And I don't care about technical definitions of GDP having to be a negative for 2 quarters for us to be in a recession. We've been in a recession for almost 2 years now. Businesses feel it, households feel it, it's hard. And the only thing that's going to rescue that is to see monetary policy loosening and to see us back out there borrowing, spending money, and dare I say it, probably buying property and borrowing money. So it's needed, the economy is struggling, and we're going to see this continue on because there is no great forecast for GDP to increase. I know that line says it is, that's Reserve Bank's forecast. I'd say it's optimistic at best. And it will still take some time for this economy to recover from some of the wounds that we've given it in the last couple of years. Of course, the reason the Reserve Bank were confident in being able to drop the OCR because they've talked consistently the only way or reason they can drop the OCR is when they're comfortable that inflation is back in its box. Inflation must be between 1% and 3%. Not only that, the Reserve Bank have consistently said we want it to the midpoint, to 2%, before they really feel comfortable the job is done. And the reason for that is they can't control all inflation. If something internationally affects inflation, sees a little bit of a jump in our inflation rate in New Zealand, they can't control that. they've got that room to move if they sit at 2%. If we just got just below 3, then you get an uncertain or a big change overseas. Jumps above 3, suddenly they're not doing their job. So they want it to 2%. The good news is it's very likely to be there once we get Q3 data. And we'll see our annual inflation rate drop to around about 2.3%. And again, as the forecast shows, not that it'll come true because they never do, it's likely to stay around about that level for the foreseeable future. But there'll be some unexpected changes, of course, whether it's a weather event, whether it's, whatever happens with the American election. China's economy struggling right now. There are still some things to be conscious of, but again, that's why we need the support. That's why the OCR4s will continue to come. I won't talk too long on that one. Business confidence has rebounded. Good news on that front, but it's also not all roses. Businesses are feeling a little bit better, but we need to see it really flow through to activity before we get too confident in those businesses feeling good. So I think it all shapes us up to say, yes, the worst is past us. Interest rate falls are here, things are going to get better, but there's also a few reasons just to keep those expectations in check. Our expectation is not that we're going to see a return to the bust phase, that we're going to see property prices take off again, but it's certainly going to improve from where we are today. And the reasons I sort of keep those expectations in check, not want to bring you too far down, is that we do have, struggling economy. That right-hand side shows the unemployment rate still forecast to increase. As people are a little bit uncertain about their jobs, that still might influence their ability or their confidence to go out there and purchase more property or to be even going on holidays and doing all these things. So that's going to just hold people back a little bit. And our actual migration data is slowing down too. So population is still increasing, just not at the same rate it was in the past. But that still mean more demand for property, either renting or buying, but it's not quite going to be as strong as maybe we thought it was 6 months ago when it really peaked at, 140,000 odd net new migrants coming into the country. And as Kiwis continue to leave as well, that's of course going to be a drain, but the net position should still remain positive for the next wee while. But, and I suppose I'd also say that we don't expect the labour market to crash necessarily, despite many difficulties, particularly where I'm based down in Wellington. But it's definitely going to be a little bit more uncertain for a little bit longer, so don't expect things to just take off again. Of course, we've spoken a lot about demand, not so much about supply. This will be something you guys are well aware of, more listings today than in the past. Very much a buyer's market, it's been spoken about today already. And we expect that just to continue for a little bit longer too. More buyers coming out, but also more supply coming up. We've seen in our data, more investors are listing their property as they've now got a shorter bright line test, so they don't have to worry about paying a capital gains tax anymore. That's led to some investors divesting, raising a bit of capital, reducing their debt, and so that's going to continue to push up supply, which might just contain that growth rate again as well. But good news for anyone trying to find a listing. And maybe the most important thing when it comes to restricting demand in future is just the affordability pressures. Proportion of income required to service a mortgage today compared to the past is pretty much as bad as it's ever been. Now, it will improve. This is the black line I'm talking about. It will improve. It's going to be pretty slow going, especially if prices stop falling, of course, and start to increase. That fights against inflation, while interest rates falling will absolutely will help that affordability. When we look at that regionally, really interestingly, that chart on the right-hand side shows 5 of our main centres. They've all bunched together, which is really interesting. Over time, they've actually varied quite a lot. Auckland's a little bit out top, but the rest of the main centres there actually are quite consistent. So we might see some consistent growth across our other main centres, but not quite the same in Auckland, though I would say Auckland a little bit unique. It does have a broader range of access points for new buyers because of all the townhouses that have been built over the last few years, that using a median value, which we do here, doesn't really paint the full picture of Auckland, much like I talked about earlier. We need to look at suburb values. We need to look at all the property types, access points, everything that's going on, and one figure as a statistic doesn't always do the job. So Auckland's a little bit unique there, but otherwise, that restricted affordability will continue to constrain demand. It will increase, but just maybe constrain how far it can grow. So really, I think when we come to one last slide, how we summarise this. At the start of the year and the end of last year, we talked about what we might call this year. We called it the underwhelming upturn. Things that improve, but be pretty tough. We've had to take the upturn out of that and just make it underwhelming, and that sort of pushes back into next year. That's our expectation from this point on. Transactions will increase year on year for the next couple of years. We expect 5% more transactions this year than last, another 6% next year, another 9% the year after. But value growth will just slowly come back again. And that chart on the right-hand side is once again a Reserve Bank forecast that will see 0.1% growth in values by the end of the year, starting to increase from next year. Now again, it won't come true, but we do expect that the long-term capital growth rate for property in New Zealand will probably drift closer to 4 or 5% rather than the 6 or 7% we've seen for the last 3 or 4 decades. So improving, but not taking off. That's probably the one-liner to leave you with today. That is me, and my time has just hit 0. How's that for timing?